breaking news here. We're getting manufacturing data. We also have your ISM and S&P manufacturing data for April coming in line with estimates just above the key 50 level, which separates growth from contraction. The ISM numbers showing economic activity in the manufacturing sector contracting in April for the second month in a row. The reading comes after GDP data on Wednesday showed the U.S. economy contracted in the first quarter for the first time in 3 years. Joining me now, Paul Gruenwald, S&P Global Ratings Global Chief Economist. Paul, great to speak with you. I do want to start on this April manufacturing data here because some interesting things under the hood. Production falling to the lowest level since May of 2020. Prices paid, highest reading since June of 2022. What does that tell you about manufacturing?
Well, it tells me that this process that started with the policy uncertainty and then moved to the markets is now starting to show up in the real data. That's kind of the last leg of this transmission. We had a decent first quarter. Maybe we can talk about that in a minute, but we've been waiting for this to sift into the real economy. The PMIs weak for manufacturing are just signaling that there's probably some weakness on the real side ahead.
And talk to me too about the employment number here rising. There was a little bit of concern this morning when jobless claims came in just a touch higher than anticipated. Yeah. Is this a sign that the employment situation is intact?
That's the critical variable, right? If you go back a couple of years to the inflation scare and the big rise in rates, we've been really focused on this resilience between consumer spending and the labor market. That's held up so far, but if you want to differentiate between the slowdown scenario and the recession scenario, it's going to center on the labor market. So if we start to see cracks in the labor market, that's going to take us into the recession scenario. Not there yet, but we're starting to see a little bit of weakness.
Mm-hmm.
I like to look at these PMI numbers like the business sentiment, just like consumer sentiment is very important for that part of the market.
Yeah.
So the sentiment seems to be pulling down, not surprisingly. The question is how quickly are we going to really start to see this stuff show up in the so-called hard numbers? Although I look at these as hard numbers, but many would call them soft numbers. But for me, firms they do the right thing and they don't have emotions involved. So when I see sentiment starting to drop, I start to get worried. I'm concerned.
Yeah. I think we're with you on that. I mean, it's not kind of a straight line, and you're right. These are soft data because we're not measuring stuff. But certainly, if you're looking at future orders, or this is going to feed into capex or something like that, it's definitely going to move the needle. We know that some of the shipments from China have slowed down dramatically. That's going to take a couple of weeks to work through the system. We know that the financial system's gummed up a bit on M&A and some of the spec grade issuance. So all that's going to take a little bit of time to feed through. But directionally, it's very clear where we're going. It's just a question of how steep the descent's going to be for the rest of the year.
Let's talk about what you just mentioned with regards to China. Obviously, one of our top 3 importers. We had about a 3% pull forward in terms of demand in the GDP data.
Yeah.
When do you anticipate that we might start to see empty shelves because of that pressure?
Yeah, well, there's some stories floating around on timelines. The ships take a while to get from China to here, but the timeline seems to be sometime in the next couple of months. The ships will stop, then the ports will be empty, and then the shelves will be empty, and then we're going to see some of that pressure. The tariff rates on U.S. and China from both sides are now triple digit, right? This is totally uncharted territory. The Chinese basically stopped the escalation. They said this isn't really meaningful anymore. So we're going to have to find an exit ramp to that, or else that's going to feed through the economy and put a big dent in our macro story.
So on the empty shelves piece,
yes.
When might we see it, and what does that cause in the economy?
Yeah, we're not kind of forecasting that particular one. The stuff that I read that I agree with is probably sometime end of the second quarter. So it's going to be, we're in May right now, so maybe the next couple of months.
And where does that leave your outlook on the economy?
Well, that's kind of factored in already. Let's remember U.S. is a services economy, so it's 70% services. But certainly we're going to see some stress on the shipment. We're going to see some stress on consumer sentiment. And we're going to have some soft spots before we maybe pull out of this next year. But we got a big descent in growth over the next couple of quarters.
Not surprisingly, the numbers that we got the other day, the GDP numbers, showed a lot of this front loading that we've been talking about, all these companies making purchases prior to the tariffs hitting. I'm slightly concerned that, all this front loading, while it sort of helped last time, it's going to hurt us in the future, right? So purchases made today are not going to be made next quarter. Now, obviously, there are some intricacies there with inventories and things like that. But are you feeling that there might be some interesting negative surprises there, too? I mean, consumers as well. Yeah. Front-loaded, but it didn't show up in the numbers. But
yeah, well, there was a funny print, right? Because we had this massive negative contribution from imports, and we didn't really get the full offset on stocking. So there might be a missing hole. But you're right, the consumer bit, which is what we watched, decelerated a bit in the first quarter. We're going to continue to see that throughout the year. We're thinking maybe you average the first 2 quarters together and maybe some of these one-off things are going to unwind. But the trend is pretty clear. But what we saw in the first quarter was maybe a slightly artificially low number for the US. And we also saw a slightly artificially high number for China because they had the opposite thing where their export boomed. So all this messy stuff around the tariffs is going to take a couple of quarters to sift through. So we shouldn't be focusing too much on one particular data print and kind of looking at the whole, the food chain there.
It does seem like the bond market is hyper-focused on ISM at the moment. We're seeing
Yes.
treasuries paring gains just a touch. To what extent do you think this market is aptly reacting to the stagflationary risks that are presented by so much of the economic data we're getting in right now?
Yeah, well, you've seen that a bit, right? And we know that prices are going to go up. We've got 4% inflation in the US at the end of this year. The question is that just a jump in the price level, or is that really going to start lifting inflation continuously? Longer term inflation sentiments creeped up a bit. But, the bond market's trying to thread that needle, right? So the Fed's probably going to be cautious. We only have 2 cuts this year. The economy's slowing, lots of stuff in the air. So I think the bond market looks like it's reflecting most of that.
And really quick, any thoughts before NFPs tomorrow?
We're all watching that. One data point isn't going to change our view, but again, we're expecting a material slowdown in U.S. growth this year, and labor market's going to be part of that story.
Paul, thank you so much. Always a great overview. Really appreciate your time.